Hi guys, it's Simon at Kairos Capital Markets. Today we're going to talk about stops and how you position them, and how to use them, and why we use them properly in the marketplace. So at the moment, this is a trade I took yesterday. This was, well, a few hours ago it was, in all fairness. And you can see it's quite a big stop really. Some people think it's silly, but let me explain to you why. Firstly, the stop does a couple of things. It will actually determine your risk, it will. So if price comes up to my stop here, I have lost X amount of dollars or pounds, whatever it's going to be. So this is a predefined risk already there. So you know what it is. You know your risk is there. The second thing about this is if price does come up to this level, I'm pretty sure I'm wrong. Okay, and that's what you need your stops for. You need them there to say you're wrong, the market doesn't think what you think, and let's get out the trade. Simple as that. So let's go over why I've put my stop up here. So I entered this price here. I actually entered on the green bit, the actual level there, no problem at all. It was done by an order, funny enough, so I wasn't even actually in the marketplace. I just placed an order for it and left it. I was quite happy with that. So if you look at the higher time frame here, the 4-hour time frame, you can see we have the trend line, a breakdown of the trend line, and we're back to the 50 EMA on the 4-hour chart. Again, if you put your price there and we had a stop around about there roughly, you can see now why I like it so much. We've got protection from the swing highs, the extreme of the swing highs as well, except for this one here. That I think is just an odd one out. We broke below the trend line, we broke below all the EMAs on the intraday chart. So for me, waiting for a pullback was perfect. The next thing was this pullback as well. If you look at it, I trade with 3 Fibonacci retracements. It's 382, 0.5 and 682. So the 618 Fib retracement level is actually at this key 54 level as well. So my stop has involved in it. EMAs from the 4-hour and 1-hour. It has the upward sloping trend line, and it has a key level and all the major Fib levels which I trade with. So for price to then rally above this, I would pretty much say I was in the wrong and I need to be taken out the marketplace, and that is why we place a stop there. So if this trade pulled back up, let's say for instance to this level here to make a head and shoulder pattern, I could still be in the trade, you see, and still be right and still make money. Because the worst thing would be this, is some people go, oh, I put my stop here because it's done everything and that's it, it'll go down, I know best. And they get a better risk reward ratio, don't get me wrong. But the problem you have there is quite literally the stop's in the wrong place. The stop can come up, test this level here at 54, come back down, and come down to the limit here, even down to 50, no problem at all. And what happens with that is, you know, you was right, yay, whoopee-doo, but you haven't got paid. And to be quite honest, the worst thing in the market is to be right, to enter the trade, only to lose, but yet you was actually right all along, just because you put your stop in the wrong place. Then the next thing as well about this is how do you define your risk here? For me, I actually put a 1% risk on all my trades. So quite literally, in this trade here is 1% of my account. My limit is around about, I think it's around here somewhere it is. Can't remember exactly at the moment, but it's around about there somewhere. And that means I get 1.35% of my account, simple as that. A lot of people go on about how to earn pips and stuff, and you know, try and get 200 pips, this, that and the other. It's not really about that. It's about proper risk management. So this is why the stops are so crucial here. Sometimes I can have a 20 pip trade and make 1%, and sometimes I can have a 50 pip trade and make 1%. It just depends what actual pair I'm trading there. And likewise, I make pips of 1,000 pip trades, no issue at all. So there are long-term and short-term trades. It's just knowing when to take them. But again, on that 1,000 pip move, I may have a 150 pip stop, so it's not as massive as people think it is. That's the deceiving thing about it. But in all fairness, guys, if you can make 5% a month, really, in all fairness, you're doing fairly well. If that's consistent as well, not like 15% one month, then 2 losing months together, like of say 2-3% each, and then go up another 10% a month, then you're back down to 0 for the next month. You won't be consistent. As long as you can just read the market, be consistent, that's the main thing. And one of the crucial things is getting your stops in the right place. Okay, guys, I hope that helps out a little bit, and I'll speak to you soon. Thank you.